Welcome to this lecture on sole trader, partnership or company. How should I start my business? My name is Dean Wootton. Now it's fair to say this is a common question in a lot of practices. New clients sitting in front of you, they're describing their business idea, you're trying to get an idea of numbers, and you're just trying to figure out, should I set them up as a sole trader, a partnership or a limited company? Now, it's fair to say it does depend on a variety of factors. How much the owner wishes to draw. Are there other income sources? Does the client need limited liability? What are the long-term succession plans for this business? Will they have the discipline to deal with the corporate structure? So lots of factors to consider. And it's fair to say there's no one-size-fits-all solution. But we can have a rough idea of what our preferences should be. Well, let's consider a scenario and just see if we can put some numbers to give us a guide on whether they should be sole trader, partnership or corporate. We're going to look at a small husband and wife business, and we're going to consider the net distributable post-tax profits, whether they are a sole trader employing their spouse, or a 50-50 partnership with their spouse, or a 50-50 limited company with their spouse. And we're going to look at profit ranges between 20,000 and 150,000. We're going to make some basic assumptions. 1819 tax rates and allowances. Finance Act 18 corporation tax rates, 19%. Salaries, directors' fees paid at Class 1 NI primary and secondary earnings thresholds, 8424. The client has no other income. And they take all the money out, so whether it be by drawings or dividends. Now when you put that into a spreadsheet, you do get some interesting results. Now you can see here that if they're earning, say, 20,000, the limited company, partnership, sole trader, it doesn't make a lot of difference. I would say the limited company is probably less attractive because you have more compliance. But then when you bump it up, 35,000, it's still pretty much indifferent, and I'm still leaning towards sole trader or partnership. 50,000? Well, you're now starting to see the company pull away from definitely the sole trader, and starting to pull away from the partnership, but not so much on the partnership. When you go higher, let's say 100,000, then obviously we see the corporate is a better vehicle, is much better than a sole trader. But notice the partnership isn't too bad. It's about midpoint. And obviously as we grow, the company does get better and better. It starts to reverse over 200,000, but we're looking at smaller husband and wife businesses here. So just to pull this together, in my mind, it's not worth thinking about a corporate until profits exceed £45,000. Corporate compliance does have an impact. It is definitely more expensive to trade as a company in terms of professional fees, compliance, etc. Now, from 45,000, a company does have good savings over a sole trader, but partnerships work for longer. They stay with the company for much longer than, say, a sole trader. And I would say partnerships are comparable to a company up to about £60,000 worth of profit. Once you go over that, corporates do have significant advantages. And those advantages, those savings, can be increased by retaining profits in that corporate vehicle, something obviously a partnership cannot do. So I've got in my head that corporates are better if projections are 60 or above. But if I'm sitting in front of a client that has lower initial projections, but they have growth potential, in my opinion, then I might well go corporate from the very start, just because I know that's where we're going to end up. Now, if I'm going to go corporate for those new startups projected over 60 or those with growth potential, then would I set up corporates with alphabet shares from the very start? Yes, I would. Secretarial agencies offer off-the-shelf alphabet companies for under £100, and that is the best time to set up an alphabet structure. Alphabet structures allow you to really exaggerate or increase the advantages the corporate has, and allows you to pay dividends independent of each class of shares. It works very well for spouses and children over the age of 18. And it's worth mentioning there was a late amendment to Finance Act 19 to ensure that Alphabet shares continue to qualify for entrepreneurs relief. So yes, my projections are over 60,000, or I've got a client less than that, but with growth potential. Yeah, I'm going corporate, and yes, I'll be considering Alphabet, corporate startups. For startups with projected profits under 60,000, with limited growth prospects, I believe a formal partnership is best. Now, I say formal partnership because I want a partnership agreement in place. I'm going to have a partnership set of accounts. Now, when I do that, I don't need to justify spouse profit shares. Now, so if I was doing, say, wages for spouse, then I would have to justify what they do. But if they are a full-blown partner in my business and they share profits per the partnership agreement, i.e. as they see fit, then there's no justification needed for that. It's a proper partnership, and you are distributing profits per the partnership agreement. There's less scope for HMRC to be interested in this type of structure in terms of are you getting what you put into it effectively. Now, if we have a startup with growth potential, then obviously I'm going to start up as a company, irrespective of initial profit projections. But occasionally, I'll misread the situation. I'll think there's a client sitting in front of me, and I'm not convinced they've got growth potential. So therefore, I go partnership. But then they really surprise me, and their partnership does much better than we thought. So at some point, we might well consider incorporating. Now, here comes another advantage with the partnership. When you incorporate from a partnership, there should be no SDLT on property that moves from the partnership into the company. So that is because of the sum of low proportions. Some of you might be using it for incorporating property portfolios. Well, actually, the key to it all is coming from a partnership. And if I set up the client as a partnership, I am giving them the opportunity to incorporate at a later date with no SDLT if they have a property at that point. There should be no CGT either, because we've got activity, it's a trading business. So therefore we've got this no CGT, section 162. So partnerships, there's no real downside to them, because if I do misread it and the client does do better than I thought, I can very easily incorporate without SDLT, without CGT at a later date. If the client was concerned about limited liability, just go LLP. So you get limited liability in the partnership structure. So when do we use sole traders? I'm thinking corporate or partnership. I'm not thinking sole traders. Well, sole traders for me would be where you're sitting in front of somebody that's single. Let's say I'm sitting in front of somebody that's a tradesman, say, under CIS, and they're single. So I'm thinking, well, sole trader for you. So single people. Probably those also with limited growth prospects. So that would be almost like the minority. So in terms of how I'd set up, my first thoughts are partnership or corporate. My second thoughts would be, well, maybe a sole trader for some. Now, finally, don't forget your VAT when you're sitting in front of a new client. Sometimes VAT is the most important consideration. If my client was proposing to teach a subject ordinarily taught in school or university, your first thought should be unincorporated. So sole trader or partnership. That will secure the Schedule 9 Group 6 Item 2 educational exemption. A subject taught or teaching a subject ordinarily taught in school or university by an independent person, i.e. not a corporate. Now, if you set them up as a company, their income is likely to be standard rated unless they are an eligible body. Most clients would not be an eligible body. They're out there to make money. And quite often that will breach eligible body status. Eligible body status is like charities and similar non-profit making bodies. So if I'm looking at a client who's teaching a subject ordinarily taught in school or university, do think about the VAT. And do be careful, because that definition of a subject ordinarily taught in school or university is very, very wide. So for example, it would include maths teachers, English teachers, obviously. But it would also include, on some occasions, horse riding. Somebody's teaching horse riding. It could also include photography. You're teaching photography. Photography is a subject ordinarily taught in school. Dance. Let's say clients setting up a dance studio. What are they doing? They are teaching dance. Dance is a subject ordinarily taught in school. So be very careful with this. The trigger for me is my client says, I am teaching, I am coaching, I am giving lessons. So if it's a golf club pro who's just to take on the local golf club's pro shop, I'm thinking, right, so he's probably got a website selling lots of goods. So let's set this up differently. So we'll have the core structure as possibly a corporate if he's quite active in selling goods. But if he's given any golf lessons, I want those given as a sole trader, exempt income. If he was to give them within his corporate, standard rated income. So VAT quite often is a concern, but only for those people teaching a subject ordinarily taught in school or university. Now, for those people, keeping all their income will be important where their customer base is predominantly individuals. Now, what that means is if they ever have to VAT register, the chances are they will have to bear the VAT themselves at 1/6. They won't be able to add 20% on top. It's a competitive market. And if they add 20% to their fees, or their charges, they become too expensive because their competitors would undoubtedly been set up unincorporated where VAT is not an issue. Well, that concludes this short session on sole trader, partnership or corporate. My name is Dean Wooten. Thank you for listening.